Good morning. My name is Alan Nochumson of Nochumson P.C, and I'm glad to have today Mike Meltzer of Meltzer and Meltzer CPAs. Mike deals with a lot of issues that our clients deal with from an accounting perspective. A lot of our real estate investors and developers and small business owners need to focus on how to, do their taxes and to properly account for their income and expenses. And I thought it'd be very informative to have Mike today. To explain a little bit about the process of, corporate formation and what to focus on when you're operating and managing your business. Good morning, Mike.
Hey, thanks for having me. This is my first podcast, so I hope I don't disappoint.
Okay, so why don't you tell our audience a little bit about yourself?
Well, I'm a CPA. I have an accounting firm in Huntington Valley. We're a small firm with 8 people. I have a lot of clients in real estate, construction, contracting. They buy and flip, they own and rent. I have quite a variety of clients. I've been doing this for 20 years. I'm also on the local tax committee of PICPA. So I volunteer my time and I try to stay ahead of the game on legislation.
Well, sounds great. Sounds great. All right. Well, let's get to the meat of our discussion. I have a client, right? Hypothetical client, Mr. Smith, right? Mr. Smith is looking to start properly investing in real estate, and let's focus on Philadelphia because that's a lot of our clientele. And we can talk about New Jersey or the suburbs, but I think Philadelphia. Let's focus and make it simple for our audience, right? So Mr. Smith comes into my office and says, "Hey, I'm looking to start investing in real estate. I want to start a little big though. I want to buy a 25-unit apartment building." I start talking to him.
Starting small. Okay, very good.
Yeah. So Mr. Smith comes to me. He's like, "Well, how should I purchase the property?" Right? Say he's actually thinking ahead, right? Rather than coming to me and saying, "I just purchased a property in my name, and what should I do?" And I would say, "Well, before you purchased it, you probably should have talked to an attorney and an accountant." But say Mr. Smith is forward thinking, right? Come to my office. Says, "I'm buying a 25-unit apartment building." Well, he's going to say, "How should I own it?" And I'm going to say, "Call Mike," because we can draft whatever you want, but and we'll protect you from a legal standpoint, and we can get an insurance broker to protect you from an insurance standpoint. But Mike's going to tell you how you should own it from his situation, from a tax perspective. So if I referred you to Mike or introduced you to Mike, what would you tell Mike? Like in terms of his options in owning the property?
Well, Philadelphia makes it very interesting. If we just talk on a federal level, it's very quick and easy. But Philadelphia does make it very complicated. We have a few choices. Our 2 choices, and forgive me for using a technical term very loosely, but you can incorporate or you cannot incorporate. You can own this 25-unit apartment in your name, have people make a rent checks out to you. It's very easy and cheap. If you were going into the rental business with a partner, you would form a partnership. You're still not incorporating. There are a lot of advantages to this form. You may not recommend it because you don't have the protection of incorporating, but you can incorporate, and you have a few choices of LLC, SCorp, or CCorp.
Okay, so before we talk about the different types of companies or corporate entities and why you should do one versus the other, and just to educate our audience of the different structures of these entities. So the first question is whether to incorporate or not incorporate. And if you're not incorporating, basically what I understand that to be is a sole proprietorship, essentially.
Mm-hmm, that's right.
Or if you have a company or you have you want to own it with someone else, it would be basically like a joint venture.
Mm-hmm. That's right.
Okay, so we have that. We have the opportunity to own it, just in the personal name. I, as you stated, would probably not recommend that because there's a lot of liability owning a building in one's name. If you get sued by a tenant, if there's a slip and fall, I mean, there's opportunities to insure against that, which is a whole nother conversation. But, what's the tax? Well, let's talk about the different entities. So you mentioned an LLC. What's that? What does that mean?
Well, an LLC is our simplest form to incorporating. You go into that area, that choice of protecting yourself. And, you know, we can have an argument later about how risky it is. But an LLC is your first line of path into incorporating. It's a lot simpler than forming a C Corp as far as how much paperwork you have to, you still have to create articles. And from the creating of an LLC, you can then find your way into the SCorp, which is one of my most preferred method of an entity type for some situations, not necessarily for real estate. We'll talk about that in a minute. I just want to mention real quick that LLCs, in the eyes of the IRS, are considered disregarded entities. So if you can imagine forming an LLC for tax purposes, you're not really doing anything. You're going to file your taxes the same way as if you were a sole proprietor when you hadn't incorporated, or if you are forming a multi-member LLC as a partnership, as if you had a partner.
Gotcha. So, I mean, just for our audience, from a legal standpoint, the LLC is actually the easiest one from a corporate formality standpoint, because all you're going to do is have a certificate of organization, you file with the Pennsylvania Department of State, you have an operating agreement, but you don't have to have meetings, you don't have to have, you know, the certain corporate formalities of a lot of paperwork you would have with a company. Obviously, you have to, you know, you can't commingle your funds and things like that. You have to
think
keep
you
it
need
as
minutes, and you need like a stamp, and you need to like register in a trade journal or something.
yeah, so it's a lot more comprehensive to do a company versus a LLC, which is a limited liability company. So, and it sounds from like a tax perspective, given that it's a disregarded entity, it makes your tax filings in some ways easier than if you did a company, right?
Yeah, yeah. I mean, it kind of adds that level of protection, but it doesn't really affect your taxes.
That's right.
You would file the same way as if you had not incorporated at all. But if you did want to become a C Corp or an S Corp, this would be a path to that entity type.
Gotcha. So why don't you tell me the difference between a C, because you keep mentioning C and S for our audience, what is the difference?
Well, the C Corp is a more traditional entity unto itself. And there's usually no one rule that fits everybody, but this one does, where I would not recommend the C Corp to anybody. C Corps are entities to themselves, which means they pay tax on the income that they make. Perhaps you're familiar with double taxation. We haven't heard about double taxation much because very few people are C Corps like they used to be.
Gotcha.
When the C Corp, after the C Corp has paid taxes, it then can distribute money to its shareholders. And after that happens, then individually you pay tax. S Corps have been that way around double taxation.
Mm-hmm.
The entity is basically the same, operates by itself, but it does not pay taxes on the federal level.
Gotcha.
All the income flows through to the individual shareholders, however many they are, although you can't have more than 100. Won't go into the technicalities, but S Corps are great for that reason, in that you're not paying a double taxation. Although I wouldn't recommend it for all situations, but those are the difference with those two.
Okay, and then the last entity type that we were talking about are partnerships. What are those?
Yeah, well, to me, partnerships are the best. I mean, if you're going into a project with somebody, you don't have to incorporate. You just be Alan and Mike partners, and you own property together. They're a lot easier as far as putting property or items or assets in and out, putting them into the partnership. That is something I wanted to talk about a little bit as far as costs of operating. I think it costs less to be a partnership than an S Corp or a multi-member LLC. But
why is that?
Why is that?
Yeah, are you saying it's cost less from a tax standpoint or just a legal?
Overall, not legal, not actually tax standpoint, just with regards to putting property into a partnership. If you own something, say you own a dilapidated building in Fishtown, and your neighbor owns a parking lot right next door, and you wanted to put the two things together and build something bigger. If you had a partnership, you just do it. Alan's parking lot, Mike's apartment. We build an apartment and we split the rent per partnership agreement.
Mm-hmm.
If we formed an LLC, we'd have to transfer that property into the LLC, and now you're paying a transfer tax.
That's right. That's right.
So there are costs with LLCs that I wouldn't necessarily recommend to everybody.
Well, that's why I was thinking Mr. Smith was forward thinking. A lot of times we represent clients who are starting out, and for various reasons. A lot of times people purchase a property in their individual name because they're trying to get a certain loan product, right? The lowest rate possible. And as an individual, the rate is a lot lower if you're an individual as opposed to if you're a company, and there's not opportunities to borrow funds as a sole purpose entity as a personal guarantor. So a lot of times our clients purchase it because that's the only way they can do it. A lot of times, sometimes they don't think about it. All of a sudden they buy one building and then another and another. And all of a sudden they have all these assets in their individual names, and they think, wait a minute, that's probably not the smartest thing, because legally, if I have an issue with one building in my name and a judgment is, I get a judgment against me, it attached to every single property I own. So like you were saying, with the transfer taxes, we see a lot of times where individuals want to own in a corporate entity for various reasons, and now they're hit with transfer taxes, and now they have to pay, in Philadelphia, 4 point something percent off the assessed value, which is some cases, a few thousand, some cases tens of thousands of dollars. So that's a big mistake. So that's why anytime you're thinking about buying real estate, come to me, come to Mike. We can talk it through. Yeah, you got to think. I tell
you want
clients,
to do that before you buy the property, because once you've bought it, you're almost a little too late.
Yeah, this is one of the sayings I have. I like to play chess, not checkers. We really try to think 2 steps ahead. What are you thinking about today, and your room for growth? What are you thinking about tomorrow, and how we can maneuver you for tomorrow, not just for today. So anyway, that's my little spiel. So all right, so now we have incorporate, non-incorporate, incorporate. We got several different structures. Non-incorporate, it's in our name. Now let's talk about like the tax implications, right? So
Yes,
we heard recently, in the news, a New York Times article that our president Donald Trump, who's a real estate developer, was.
Oh, you're jumping to the good stuff quickly.
Yes, yeah. So he didn't pay taxes personally 10 out of the past 15 years allegedly, and the last 2 tax years he only paid not $750,000, $750.
Yes.
So, and I assume you're not representing Donald Trump, but you could represent a lot of clients who are developers or aspiring developers. Let's talk about tax planning, right? So it's not just, because actually I think next week you have to pay your personal taxes, September 15th. Well, at least if you have an extension, which I always do because I never have time to file anything. But well, what?
I'd love to go into what I think is going on with Donald Trump. I mean, when I tell you what I know about the tax code, you won't jump on him right away. I totally can defend Trump on owing very little in taxes. But first, let's start with the tax benefits, which is the real meat of this conversation, the different tax benefits with these different entities. On the federal level, I have almost always recommended an SCorp. It is commonly known that the SCorp is the best entity for avoiding taxes for most situations, because you don't pay Social Security tax on income that flows through an SCorp. As a sole proprietor, general partnership, you do pay Social Security tax on income. However, rental income is not subject to Social Security tax. So once you say you're already not paying Social Security tax, there's no reason to be the SCorp. For federal purposes, there is no tax difference for any of these entities. Now, on the city level, it changes dramatically. Let me just start out with, if you are a Philadelphia resident, you do not want to be an SCorp. You will be paying more in taxes if your real estate is owned by an SCorp.
And why is that?
Well, there's a little bit of a double taxation. You know, Philadelphia has a kind of unique tax code. So most government agency, when I say most, I mean like states and the federal government, has one form for taxing all your income. So we're not going to talk about all the different forms Philadelphia has, but they have a form for your wages, a form for your business income, and a form for investment income. So Philadelphia, first of all, your business, your SCorp, is going to pay income tax. And then you individually are going to pay income tax on the distributions. They treat the distributions that flow out of your SCorp like dividends, like you get from a stock from a C-Corp.
That's like, and my law firm is in SCorp, so I'm very familiar with that. So my dividend income is paid, and it's called the school tax, right?
It is. It's called the school tax, right?
That's right. And I will say that the city of Philadelphia has definitely been auditing individuals who own S corps more and more. I always pay my taxes. You'll appreciate this. My first accountant told me, "Would you like to eat well or sleep well? If you would like to eat well, you should be very aggressive in terms of your deductions, other things like that. If you like to sleep well, you know, you know, tell the government what you have. Be very conservative in terms of your deductions. I've always liked to sleep well, but I've heard, and I pay all my taxes, so it's not worth it to me not to. But it is an honor system.
Good boy.
Unfortunately,
I
if you
applaud
get,
you.
yeah, yeah. I mean, unfortunately, there are people who are like, well, there's only so much of audits and stuff like that. So I heard that the biggest issue is the school tax, because it is a tough tax. It costs
Yeah.
a lot of money. And I've seen individuals, like I've heard through my accountant, that some individuals were like, it's a voluntary tax. Nothing's a voluntary tax. So
No,
yeah,
they audit you. The city will audit you.
yeah. So it's a
I've
really,
seen it. I've had clients who got spanked, you know?
no, I have. Oh no, it's horrible, but it's a tough tax. The other thing is, and you know as well, is that when you're a company in Philadelphia, you not only have to pay your tax burden for that particular tax year, then you have to pay it for that same amount for the following year,
Yeah.
right?
Yeah. That's a tough pill to swallow because it kind of doubles your tax bill. Like if you can imagine any given year, 25% of your income is going to your silent partner, you know, the big brother in DC.
Mm-hmm.
Double that. You know, nobody wants to pay 50% of their income. Now, it's not that bad. But
Yeah,
to the city of Philadelphia, if you're maybe paying 4%, 6%, you know, in your first year of, you know, really good profits, you got to double your tax. Now, you are going to get that back in future years as, you know, things level out and your income is the same year after year. It's not going to really feel that bad. But, you know, it makes it feel worse than it really is. And, you know, the school income tax you mentioned is maybe the biggest bear. There is, if we're going to list them, the net profits tax, which individuals and partnerships have to pay, business privilege tax, which businesses have to pay on top of the wage earning reconciliation.
that's right. So it sounds like an S corp, you definitely have more tax liability from the city standpoint. So how does that compare with like an LLC?
So if you were a multi-member LLC, now LLCs are basically disregarded entities. So I'd
Mm-hmm.
like to say partnership or sole proprietor.
Okay.
If you were just a partner or a sole proprietor, which you could be if you created an LLC, you don't pay the school income tax. You know, you don't pay that double tax, just to keep it simple. You just pay the income tax once to the city of Philadelphia and you're fine.
Gotcha.
If
Gotcha.
you're a Philadelphia resident, let me throw out there, if you're not a Philadelphia resident, you are not subject to the school income tax. If you are not a Philadelphia resident and you own an apartment in the city of Philadelphia, I would 100% and only recommend SCorp. I would say you should be an S corporation because now in that situation, you individually are not subject to the school income tax. You're not paying a double taxation. You're also not paying the net profits tax, which is one of the things I listed before.
Oh, geez.
not to go into too much detail, but you would pay less if your entity type was an SCorp, if your building was in Philadelphia and you lived outside, than you would if you were a sole proprietor or a partnership.
Sounds like I need to put the for sale sign in my Philadelphia house.
I moved out a long time ago. As soon as I reached a certain bracket, I don't know what you're waiting for. You're a walker. That's what it is.
That's right. That's right. And so we talked a lot about this, the city components, as a resident, as a non-resident, the different taxes and the different tax burdens based on the different type of entities. When we talk about like the state, my understanding is that that's pretty simple, right? Doesn't matter what type of entity you are, you pay X, right?
Pennsylvania is really great. I mean, not only do they not have brackets, they have a flat tax, which people talk about all the time. Pennsylvania taxes you at 3%, whether you're an S-corp partnership, sole proprietor. So we never really talk about Pennsylvania when we talk about tax strategies. New Jersey kind of makes it interesting. We're not going to talk about it. Philadelphia
Yes.
really is where the conversation starts and stops.
Gotcha. Now, I'm sorry.
Well, there is one more thing. I mean, I'm sure you were going to ask me about the 20% business deduction, not to steal your thunder.
Well, no, I was going to say, let's talk about the federal, because I think other than the city being convoluted and trying to get your money in different ways, I think the federal tax apparatus is a way for you to add value to clients, because there's opportunities in terms of deductions and depreciation. I wanted to save that for last, because that's where I think, that's where an accountant actually adds value. So you were mentioning this 20% deduction?
Yeah. Well, I don't know if you want to shame me for adding this later. The sun just went down on me, so the lighting is changing on me. Earlier, I said there was no tax difference between entity types for rental purposes. You're not subject to Social Security tax. You're going to pay the same kind of tax no matter what entity you are.
Mm-hmm.
Now, there is this new 20% business deduction that they started 2 years ago that is not really eligible to everybody. So let me give you, for example, you have a father with money and a son with energy, and they want to buy a house and rent it out. So the dad, wants his flat 5% interest. So he lends the money to his son. Son operates as a sole proprietor. The dad gets his interest, and the son pays tax on whatever is left over. They lose 20% deduction on that interest that he's getting, because interest is not eligible for the 20% deduction. Rental income is, to a certain extent, eligible for that 20% deduction. So they would be better off, instead of the dad lending money to the son, forming a partnership and then doing some math, figuring out, what percentage owner should the dad be, making sure he gets his cut and then the son gets his cut. Overall, as a family, they would be paying less in taxes.
So that's the nuances, right? That talking to a real estate professional and a tax professional, you get the same amount of money gross. How much do you get to keep, right? So, I just want 5%. It's how you label that 5% that makes a big difference. Here, someone would be eligible for deduction, while someone in the other realm would not, right?
There is one more thing. There is one. Now, this is very new, so I can't say you're not going to be eligible for the 20% deduction as a sole proprietor, but there is a little bit more stringent requirement. So they do require you spend 250 hours a year to legitimize that this rental activity is a business, because that's part of this 20% deduction. It's a qualified business income is eligible for the deduction. If you have, God bless you, if you got one of these triple net leases, you're not putting a lot of work into this rental property. This might seem more like investment income than business income. So for that reason, you may want to incorporate or form the LLC, because this 250-hour requirement isn't subject or isn't put upon K1 income or small businesses. It's really just for self-employed individuals.
That's right. Well, if you think about 250 hours a year, it's only 5 hours a week. I mean, I think most people would fall under,
Oh yeah,
working
I
five
have
hours a
rental
week.
property myself. I put in way more than 250 hours. So for a lot of people, and I only have three like condo units. So
There you go. So we hear about that, opportunity. What are other things that, if you're a real estate investor, you should be mindful of from a tax planning perspective? Like, what are the other deductions you should, keep track of, or investments you should make into your company to take advantage of all the tax opportunities?
well, once you get past the business type, and we're just talking generally, this is one of the big conversations I have every year with my clients. It's about what can I deduct, and it boils down to creating a business purpose for whatever you wanted to deduct. Number one in my book is the cell phone. You use your cell phone to call tenants or receive tenants or vendors or contractors, and so that has a business purpose. So you should be deducting at least some of your cell phone bill.
Your,
To
your,
answer
your,
your question, you want to find a business purpose for anything you want to deduct. You want to deduct as much as possible to reduce your tax bill.
yes, I should see a way I can deduct the expenses related to my dog.
Yeah. If you advertise your apartment building as a pet friendly place, emotional support landlords, you bring your dog around. That's 100% a business
That's
deduction.
right. I'll bring my dog around during my site visits to the property. He'll be called security.
Uh-huh. Oh, he's a security dog too, right? He's gonna sniff out any
Yeah,
hooligans.
there you go. There are a couple of daycare visits will be paid for. Other things I would think about your car, right? Especially if you have multiple properties. You're using that car. Is that something you can deduct?
Yes. So, as you drive around, and usually I take the mileage because that's easy. But if you're doing a lot of driving, you might want to really keep track of your gas and then take a percentage of your insurance and maintenance. Um, yeah, absolutely. You drive to your property, you drive to the hardware store, keep track of those mileage. Um, if you're a really do-it-yourself kind of guy and you mow the lawns on the weekends, you can deduct the car. So your car, your phone, pretty much anything. And if you start going into the home office deduction, I mean, you can deduct part of your home.
That's right. And then any equipment like computers, or like you were talking about lawnmower. If I mow not just my home lawn, but like if I use that to like actually mow the front lawn of my 25 unit apartment building that Mr. Smith has, right? Or Mr. Smith does that, right?
Yeah.
Yeah.
Yeah,
What
that's why
about
you got it in the first place, to maintain your property. So the key is finding a business purpose for anything
yeah.
you do, or for everything you do, make sure you keep track of it.
So that's right. So when I come to you at the end of the year and I'd say, well, is there any way to reduce my tax liability? You're like, well, here's a checklist. Well, if I didn't plan the whole year, all of a sudden I'm scrambling, right? Oh, let me go through all of my credit card statements. Let me go through all my time. It's good to keep stuff contemporaneous, right?
Yeah. Well, generally, when we talk about accounting systems, there's lots of ways to do it, paper or digital. It definitely makes things easier to keep track as you're doing it. But there are other ways, we can talk. Technology has gotten so great. I've always said computers are going to be taking over my job. I totally see some digital Mike Meltzer in 10 years doing this podcast talking about business entities. But
Derek.
computers are totally taking over the business, and they can do a really good job of your accounting if you know how to set it up. There's a lot of ways to do it, really.
That's right. We have QuickBooks Online ourselves, and it kind of keeps things almost in an autopilot point of view. I heard a phrase called depreciation. Is that something that real estate developers and investors can take advantage of?
Yeah. Well, depreciation is, a plus or minus. It's a bane or a benefit. When you put a lot of money into buying a new property, it kind of sucks because, am I allowed to say that on a podcast?
You can
Because you
say
can't.
whatever you want. I mean, I hate to say it nowadays, the decorum in the professional world and in our society is going lower, lower, and lower. I've
Yeah.
heard worse.
Oh, okay. Well, one of the George Carlin's seven, curse words is no longer a curse word. But well, anyway, if you can imagine dumping a lot of money into a project and not being able to deduct any of it, that sucks. So
Yeah.
that's depreciation. If you buy a building for $100,000, you can only take 1/30th of it, or 1/27th of it, depending on a lot of things. But, over the next 30 years, you're deducting a little bit of the building, even though you don't have that expense. So you might be making $100,000 in rent in a year, but you're subtracting from that this depreciation from when you bought it, several years ago. So you're not actually paying tax on 100,000. So depreciation is kind of it's good to know about, something your accountant takes into consideration, has to keep track of. So for educational purposes, it's good to know.
Yeah, and then the final thing is, and I think it was really highlighted when we were talking about the Trump tax returns. It's about losses carrying forward. Like, and I don't think a lot of people understand that. But when you are a business owner, and especially if you're a sophisticated real estate developer investor, some deals work out great, some not so much. And how one can take not advantage, but like take into account when that deal doesn't work for whatever reason, and to kind of put it on to help you on the deals that happen go really well. So what's this thing about carrying losses forward,
Yeah.
or maneuvering it around?
Well, I was totally thinking about the Trump situation as I was talking about depreciation. I mean, if you can imagine, let me talk about Trump because this is how I imagine it. If you inherited a building, or maybe you've owned it for 30 years and it's clear and free, you don't have a mortgage. It's worth like millions of dollars. Maybe you're making a couple 100,000 in rent from it, but it's worth millions. But now you see a project in Atlantic City that you want to get into and you don't have a lot of cash. If you sold that building, almost a half of that profit will go to the government in taxes.
Mm-hmm.
So instead, you finance it. So now all of a sudden, you've got, millions of dollars free and clear. You don't have to pay tax on it because you borrowed, leaned, leveraged against that building, and you invest in this project in Atlantic City, which you can deduct. So now you've got all these expenses and losses with no income to offset it. You're going to be carrying that for a long time.
Gotcha. So he pulls the equity out of one property to finance or acquire another property.
Yeah, and then you can keep rolling that on. And really the conversation has been, who does he owe? Because he's borrowing money, which is why he has these losses. You don't pay tax when you borrow money, but when you use that money for investments, for projects, you can deduct that. Also, before I said I never recommend C-Corps to anybody because of the double taxation. Well, he probably has a lot of his entities, a lot of his investments in C-Corps. So those entities are paying tax before the money gets to Donald Trump. But they might be holding a war chest of cash. And he knows, just like anybody, if he takes that money, say that corporation made money, paid taxes, is ready to distribute hundreds of thousands to its one shareholder, he knows he's going to have to pay tax when he takes that money. So maybe he went to a bank or somebody and said, look, I have hundreds of thousands of dollars here. Instead of me taking that, can I borrow from you? You'll put a lien on, I'll put that money in escrow in your account. I won't touch it. Now he's saving 20, 30% in taxes that you don't have to pay. He's got more money in his pocket that he can invest in projects. So I totally believe he's utilizing the tax code. He's paying $750 in tax, and there's nothing wrong with that.
That's right. But he's leveraging it. He's like compartmentalizing that money. Instead of giving it to the government, what I'm hearing, he's giving it to the banks, or he's giving it to
Yeah.
whatever industry that requires that to get additional funds.
Yep.
Gotcha. All right. Well, this is really informative. Is there anything that we missed?
You know what? There is one very important subject. I could have mentioned this at the same time of depreciation, and that's cost segregation. You know, just remember those words more importantly than you remember depreciation, because a minute ago I told you about how when you buy a building, you can only take, 1/27th of it, 1/39th of it.
In terms of
In
depreciation.
terms of depreciation, it's going to take you 27 to 30 years to expense that whole building. But there are other things that you can expense more quickly. Things that are removable that aren't a building, like a fence that surrounds the property. HVAC unit, some of these things that you replace more quickly, you can depreciate more quickly. It's good. There's a real long conversation about segregating things that aren't, bricks and mortar, things that aren't physically attached to the building. You can consider depreciating more quickly. So cost segregation, you don't need, there are companies out there that's all they do. You hire them, they come to your skyscraper and they say, these are the things that are not permanent and you can expense more quickly. You don't need, a very high expensive accounting team to do it. You can kind of, if you buy your own place, say, the mats here are separate and the washer and dryer and a couple of things like that.
So when I'm doing a renovation job, it doesn't matter the scale, whether it's single family or like a multi-unit building or this apartment building I want to refresh, it sounds like there's opportunities where I can take a lot of the equipment and things that are not considered fixtures, so to speak, and depreciate them quicker to actually, it almost pays for itself in some ways.
Yeah. Well, I mean, if you have a lot of income from other sources, you really want to write off as much as you can as quickly as you can. So you want to allocate as much cost towards those things, and just on paper separate them. In your renovation example, and if you Google search cost segregation, you'll get a whole laundry list of examples like appliances and washers and dryers. Movable objects.
So that brings us to a good end. And in terms of if you go online, how are they going to find you, Mike?
Oh, what a segue.
Yes.
MeltzerCPA.com, just like my last name, www.meltzercpa.com. If you Google search me, I'm pretty sure I'm the only one. There's a Meltzer in DC that might come up who's an accountant, but you want the one in Philadelphia. I'm actually in Huntington Valley, but I come up in all the searches.
And if they want to call you or email you, how can they do that?
Okay, well, my phone number is 215-244-7737. And my email is like my name, Michael@MeltzerCPA.com.
Well, thank you so much for your time. I really appreciate it. I do think this was very informative. I think it's an opportunity for people who are investors and developers and even small business owners to look at their books and reduce their tax liability as much as possible. So thank you so much for your time.
I think I gave you a lot. You can take all of this, you investor, to the accountant and have an intelligent conversation. Now you know all this. Sit down and, make a wise decision.
Great. Thank you so much.
Thank you.
All right.